CFA Level 1 Practice Questions. Learning Module, Exchange Rate Calculations. Topic, Cross-Rate Calculations. A currency dealer provides the following spot rate quotations. Euro per USD, 1.0850. Euro per GBP, 0.8520. Euro per JPY, 158.40. The spot GBP per USD cross rate is closest to A 0.7853, B 1.2735, C 1.4601. A Canadian traveler returns from Japan with 300,000 Japanese yen. A foreign exchange dealer quotes the following spot rates. USD per JPY equals 0.00667. CAD per USD equals 1.3513. The amount of Canadian dollars the traveler would receive for his Japanese yen is closest to A. 1,481, B. 2,704, C. 6,806. Spot rate for USD GBP equals 1.25. Expected change over next year equals negative 2.00%. Spot rate for Australian dollar per USD equals 0.72. Expected change over next year equals plus 3.50%. Spot rate for JPY per GBP equals 185.00. Expected change over next year equals plus 1.50%. What is the expected Australian dollar per JPY cross rate in 1 year? Is 0.0049. B 0.0051. C 0.0047. Dealer A provides the following spot rate quotes. Currency pair spot rate. GBP Australian dollar 1.8200. GBP CAD 1.7100. GBP CHF 1.5300. Dealer B is quoting the Australian dollar per Canadian dollar cross rate at 0.9450. The arbitrage profit that can be earned is closest to is 6,126 Canadian dollars per million Australian dollars traded. B 5,440 Australian dollars per million Canadian dollars traded. C 5,440 Canadian dollars per million Australian dollars traded. Assume the following. Current spot rate for GBP USD equals 1.2800. Forward rate for USD CHF equals 0.9100. The USD CHF forward rate reflects a forward discount of 150 points to the spot rate. The spot rate for GBP CHF is closest to 1.1840, B 1.1456, C 1.1685. GBP USD is not directly quoted, so you must derive it using Euros USD and Euros GBP. Since Euros GBP is given, you need to invert it to get GBP Euros, 1.1737. This is the critical move. Once GBP Euros is found, multiply it by Euros USD to get GBP USD equals 1.2735. You must convert JPY to USD using USJPY, then USD to CAD using CAD USD. This gives CAD JPY directly. First, convert 300,000 Japanese yen into USD using USJPY. Then, convert that USD amount into CAD using CAD USD. This confirms the traveler receives 2,704 Canadian dollars. Chain throughout USD to USD GBP to GBP JPY. Also note the inversion step for JPY GBP to get GBP JPY. Apply the percentage changes correctly to each spot rate to get the expected 1-year rates. Then repeat the cross-rate calculation with the adjusted values. Using GBP out and GBP CAD, you get out CAD equals 0.93956. This sets the benchmark for comparison against dealer B's quote. Dealer B's out CAD 0.9450 is higher than dealer A's 0.93956. That difference creates an arbitrage opportunity. The explanation shows step-by-step how borrowing CAD, converting to out at dealer B, then selling out at dealer A yields a profit of 5,440 Australian dollars per million CAD traded. If you interpret the quotes in base price (BP) format, the profit appears in CAD instead of out. But since CFA curriculum uses price base (PB), this is not the correct answer. The USD-CHF forward rate given 0.9100 already includes a discount of 150 points. You must add back the discount 0.0150 to find the spot USD-CHF equals 0.9250. Once the correct spot USD-CHF is determined, multiply GBP USD 1.2800 times USD-CHF 0.9250 to get GBP CHF equals 1.1840. Topic: forward rate calculations. The GBP Euro spot exchange rate is 0.8992. If the 1-month forward rate is 0.8987, the forward premium or discount in percentage terms is closest to is 0.99%. B negative 0.00056%. C negative 0.056%. The spot rate for your GBP is 0.8500, and the 6-month forward rate is 0.8450. Which of the following is true? A GBP is at a forward premium. B euros is at a forward premium. C both currencies are at neither a premium nor a discount. The spot rate for GBP USD is 1.2550, and the 6-month forward rate is 1.2635. The 6-month forward points are closest to A plus 85.0, B negative 0.0068, C 0.0068. A 9-month forward exchange rate in CHF USD is 0.9875, and forward points are 3.9%. What is the closest CHF USD spot rate? Is 0.9505, B 1.0250, C 0.9875. A dealer quotes the following for odd CAD. Spot rate 0.9500. 1-month forward points, plus 20. The 1-month forward rate for odd CAD is closest to is 0.9480, B 0.9520, C 1.150. A company observes that the 6-month forward rate for your JPY is 150.00, while the spot rate is 152.00. Which statement is most accurate? A. The euro, euros, is trading at a forward premium versus the yen, JPY. B. The forward percentage for your JPY is positive. C. The euro is expected to weaken against the yen over the next 6 months. Spot rate S CAD USD equals 1.2000. CAD interest rate 2% per year. USD interest rate 5% per year. Time period 1 year. A forward premium indicates A. An expected increase in demand for the base currency. B. The interest rate is higher in the base currency than in the price currency. C. The interest rate is higher in the price currency than in the base currency. The spot rate for USD CHF is 0.9200. The 6-month U.S. interest rate is 4.0% per year, and the Swiss franc interest rate is 2.0% per year, both based on a 360-day year. The 6-month forward points for USD CHF is closest to A. 92.91, B. 91.09, C. negative 90.19. The following information is available. Spot exchange rate ABC XYZ equals 1.3250. 180-day interest rate in XYZ equals 2.00%. 180-day interest rate in ABC equals 3.20%. All rates are quoted on a 360-day year basis. The 180-day forward points, scaled up by 4 decimal places for ABC XYZ, are closest to 156, B 79, C negative 78. If the foreign currency is trading at a forward discount, then relative to the interest rate of the domestic country, the interest rate in the foreign country is most likely A lower, B higher, C the same. An investor shorts 1 million US dollars. The following data applies. Spot rate USD EUR 1.2500. 1-year interest rate in the US 2.5%. 1-year interest rate in the Eurozone 1.5%. 1-year forward rate USD Euros 1.2700. What is the closest risk-free arbitrage profit available in USD? Is 6,240. B. No arbitrage opportunity. Forward rate reflects interest rate differences. C. No arbitrage opportunity. Result is negative 25,984. An analyst observes the following market data. Odd USD spot rate 0.6600. Australia 6-month interest rate 3.20%. United States 6-month interest rate 2.40%. All interest rates are quoted on an annual basis. Odd USD is the amount of odd per 1 USD. The 6-month forward rate, odd USD, is closest to A 0.6626, B 0.6569, C 0.6648. A currency trader observes the following market rates. Spot exchange rate SFD equals 2.1500. 9-month forward rate FFD equals 2.1580. Domestic 9-month risk-free rate equals 2.50% annual. Foreign 9-month risk-free rate equals 4.20% annual. A riskless arbitrage profit exists that is closest to A 0.89%, B 1.00%, C 1.42%. The forward rate, 0.8987, is lower than the spot rate, 0.8992, which indicates a forward discount. Forward divided by spot minus 1 times 100 equals negative 0.000556, negative 0.056%. The difference, minus 0.0005, equals negative 5 pips, confirming the discount. CFA uses the price-based convention. Euros is the price currency, GBP is the base currency. Since the forward rate, 0.8450, is lower than the spot, 0.8500, forward points are negative, meaning GBP is at a forward discount and Euros is at a forward premium. A higher interest rate on the base currency relative to the price currency leads to depreciation of the base and appreciation of the price currency. This confirms Euros is trading at a forward premium. Subtract the spot rate from the forward rate and then scale by 10,000 to express in pips. This gives plus 85 forward points. Forward points and effects are quoted in pips, not basis points. For most currency pairs, 1 pip equals 0.0001. This distinction ensures the correct interpretation of the 0.0085 difference as plus 85 pips. Forward points in percentage terms are calculated as forward minus spot divided by spot. This relationship allows you to back out the spot rate when the forward rate and forward points are given. Spot rate equals forward rate divided by 1 plus forward points percent. Substituting the values gives the spot rate 0.9505. Forward points are the difference between the forward rate and the spot rate, expressed in pips. Subtract the spot rate from the forward rate. 1.2635 minus 1.2550 equals 0.0085, and then multiply by 10,000 to convert into pips. This gives plus 85 forward points. Pips are the standard unit in FX markets, 0.0001 for most pairs, 0.01 for JPY pairs, ensuring the correct interpretation of the difference. A forward discount means the forward rate is lower than the spot rate. Forward percentage is calculated as forward rate minus spot rate divided by spot rate. Since the forward rate is lower, the result of this calculation is negative. This implies the base currency, euro, is expected to depreciate, weaken, relative to the price currency, yen because higher interest rate than interest rate on price currency. Forward points are negative when the base currency is at a forward discount. Therefore, if the base currency is at a forward discount, the forward percentage is guaranteed to be negative. Identify base versus price currency correctly. In CAD USD, CAD is the base and USD is the price. Since the forward rate, 1.2353, is higher than the spot, 1.2000, this indicates a forward premium driven by the higher interest rate in the price currency. USD at 5% versus CAD at 2%. Investing in USD yields more when converted back to CAD, which matches the forward rate calculation. This reinforces that the premium arises because the price currency's interest rate is higher. Use covered interest parity formula. Plugging in the US, price currency, and Swiss, base currency interest rates gives a forward rate of 0.91098, which is lower than the spot rate of 0.9200. Forward points equals forward minus spot times 10,000 equals negative 90.19. The negative value shows the base currency USD is at a forward discount. Apply the forward rate formula using the interest rate differential between the price currency, ABC, at 3.20% and the base currency, XYZ, at 2.00%. Substituting the values gives a forward rate of 1.33287, compared to the spot of 1.3250. The difference, 0.007871, scaled by 10,000 equals about 79 forward points. Use covered interest parity formula. If the foreign currency is at a forward discount, the forward rate is lower than the spot rate. This happens when the foreign currency's interest rate, price currency, is higher than the domestic currency's interest rate, base currency. Apply the interest rate parity formula. The key step is borrowing USD, converting to euros at the spot rate, investing in euros, and then using the forward contract to convert back to USD. The forward conversion yields $1,031,240 US, while the repayment obligation is $1,025,000 US. The difference is a risk-free arbitrage profit of $6,240 US. Recognize that AUD USD is quoted in price-based format, meaning AUD is the price currency and USD is the base currency. Convert annual interest rates into 6-month equivalents. AUD equals 1.6%, USD equals 1.2%. Applying the formula gives 0.6626. Forward rate implied by interest rate parity, 2.1769, is higher than the actual forward rate, 2.1580. This mismatch signals an arbitrage opportunity. Borrow the weaker currency, domestic, convert to foreign, invest at the foreign rate, and then lock in the forward contract. This produces a riskless profit of about 0.89%. If the calculated forward is greater than the actual forward, borrow domestic. If calculated forward is less than the actual forward, borrow foreign.